There's a moment in every trader's journey when the market stops falling and you face a new kind of challenge. As the market recovers, two powerful emotions emerge: fear of losing again and FOMO, the fear of missing out. That's why you need a re-entry checklist. A solid system protects you from both fear and FOMO, giving you structure when emotions run high. Successful market re-entry requires three things: clarity about conditions, timing your move right, and confidence in your decision. Welcome to Money Mastery, your step-by-step guide to financial freedom and wealth creation. Exiting the market too early creates regret and anxiety, especially when you watch it rise without you. Your heart races, your mind spins, and every green candle whispers that you're missing the opportunity. You're missing it. Hurry! That's the voice of FOMO pulling you back in. This video ends that emotional cycle permanently by giving you a clear system for confident re-entry. Most traders think success comes from charts and indicators, but it really depends on impulse control, emotional discipline, and avoiding big mistakes. These three elements, impulse control, emotional discipline, and mistake avoidance, are the psychological foundations that separate disciplined traders from emotional ones. A checklist strengthens all three safeguards at once, creating the stability you need to avoid crashing yourself when emotions run high. Professionals use checklists and structure, while amateurs rely on hope and gut feelings. That's the fundamental difference in their approach. Jumping in early, going full size immediately, and revenge trading all lead to the same devastating outcome: blowing up your account. Before you even think about entering, you need to assess whether the market has calmed down enough to consider positions. Look for smaller candles, fewer gap downs, mild reactions to news, and volatility slowly compressing. These are your calming signals. Calm first, entries later. Next, stop staring at everything and focus on finding sectors that refuse to break during weakness. Watch for sectors that fall less, bounce quicker, hold support for days, and trend sideways while others crash. These show relative strength. Future leadership doesn't scream for attention, it whispers. When markets flip behavior and start trapping sellers instead of buyers, that's your signal to pay close attention. Bad markets break levels and keep falling, but healing markets break levels and snap light back up, trapping sellers instead. When breakdowns stop working, sellers are losing control. Price shows intention, but volume shows commitment. That's why you need both to confirm a real recovery. Price movement connects directly to volume commitment because volume reveals whether there's actual conviction behind the move. Higher volume on green days, lighter volume on red days, and buying stepping in near support. These are your bullish volume signals. No volume, no trust. This is where retail traders destroy themselves by going all in when they think the market is back. Retail traders rush to go all in, but professionals think, let's test the water first. That's the difference in risk management philosophy. Start with 20 to 25% of your normal size, watch how the market behaves, and only add if conditions prove themselves. Small positions teach, large positions punish. Think of building your position like constructing a house. Foundation first, walls next, roof last. Layer 1 is your foundation entry. Layer 2 adds on strength, and Layer 3 confirms the trend. That's how you build a complete position. Position building mirrors house construction because both require proper sequencing and structural integrity to avoid failure. Rushing creates cracks. Re-entry is not victory. It's still uncertain, still fragile, and still developing, so you need to keep your protection on. Uncertain conditions, fragile recovery, and developing trends all share one trait. They demand continued caution and protective measures. Keep your stops tighter, trim faster, and review positions more frequently. These are your enhanced risk controls during uncertain periods. You respect the market until the market earns your trust. Before you enter, ask yourself honestly, am I trying to recover losses fast, chasing others, bored or angry at the market? Trying to recover losses quickly, chasing others' success, trading from boredom, and feeling angry. All four point to the same problem: wrong position size. If emotions are loud, position size is wrong. Here's the complete checklist, all 8 steps consolidated into one verification tool you can use before any re-entry decision. Market calming leads to visible strength, then failed breakdowns, volume confirmation, starting small, building in layers, keeping protection, and checking emotions. That's the full sequence. If one box is empty, you are not ready yet. Be honest. Which step do you struggle with most? FOMO, starting small, waiting, or emotions. Re-entry isn't about courage or boldness. It's about structure and disciplined frameworks. When you have structure, it removes the market's control over your decisions and gives you control over your own behavior, leading to trading success. The market stops controlling you and you start controlling your behavior. If this checklist helped you, hit that like button. It's a simple way to support the channel and help us grow. Subscribe to Money Mastery for your step-by-step guide to financial freedom and building real wealth. In the next video, I'll share a downloadable re-entry cheat sheet you can print and keep right beside your screen. Thank you for watching, and I'll see you in the next video.